Let's now welcome in Rob Haworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, it is good to see you. So we were just talking there, Rob, to our colleague Rick Newman about tariffs. President Trump talking very tough there. These tariffs on Mexico and China, Rob. He's saying they're going to proceed as planned. An additional 10% levy on China, Rob. I'm curious, as an investor, as a strategist, you hear all this, Rob. How do you try and make sense of it?
Well, I would say we're following kind of Austin Goolsby's mantra, which is a little bit of wait and see, and how does this impact the data? We were very close to 20+% tariffs on Mexico and China a month ago, and they were delayed at the last minute. I think that's some of what the market is looking at as we think about a range-bound market here, where we're evaluating what are we going to get. If we get them, I think the challenge for us is what does that actually do to economic data? And I know we've had a couple of concerning data points over the last couple of weeks. One would be January retail sales, but that seems explainable by one-off effects. Two would be today's initial jobless claims report, but it is a weekly number. It tends to be highly volatile. That could be a one-off as well. So we're waiting to see if there's a trend that we are damaging consumption in this economy. That has been the primary driver of economic growth if we think about the last year and a half. And that's what we're looking for as we move forward. So tomorrow's personal income data, PCE data will be important. And then the jobs report a week from tomorrow will also be really important. What is the consumer really experiencing? Are they still employed? Can they still spend money? Or are they starting to pull back because of all this uncertainty? And certainly what we've heard from earnings season so far is companies are not clear on the full year of 2025.
They're not clear, and they're worried about tariffs too, Rob. Bloomberg crunched the numbers on the mentions on conference calls of tariffs, and they're at a new record. Something like 700 times they've come up during these quarterly earnings calls. So, you know, it's not just consumers who are paying attention to these headlines. It's obviously companies that are too. So again, I understand the wait and see aspect of all this, but 10% tariffs on China, additional tariffs on China are already in place. 10% then on top of that, it seems, are set to be going into place. And that Canada-Mexico deadline, it's around the corner. So, you know, I understand also the impulse to wait for it to show up in the data, but I mean, everybody's talking about it at the very least.
Yeah, we can't wait too long. And certainly you're seeing some some technical challenges for the S&P 500 today. I think we'll pay attention to that. For now, we'd still say, it's a glass half full economy, right? We have 4% unemployment, even at 242,000 last week. That's a very low jobless claims number when we look at history. And consumers have been fourth quarter GDP growth was still 2.3%. So we still have a fairly constructive background, and we don't want to miss kind of the next level for the market. I think that the challenge and the risk is one, at what we're seeing today kind of from some of the tech stocks is valuation and any potential hit to growth. But there's other areas of the market that are actually inexpensive and maybe benefit from the Treasury Secretary's preferred lower 10-year Treasury yield. Thinking of income-oriented names, real estate, healthcare, right? There's probably some room for rotation in this market as we look out over the next 6 months. And it's worth thinking about your overall portfolio position and maybe not be too concentrated in those top 8 names and start looking into other sectors of this economy.
Rob, you mentioned earnings. I did want to get your take just on NVIDIA. We were waiting on pins and needles, Rob, for that report, right? It was going to be the most important report of the earnings season. We were all going to hang on, every word of CEO Jensen Huang on the call. And clearly investors seem disappointed today, Rob, in that report. I'm just curious, that report, the reaction, the response to it, are there broader lessons for the market as a whole, Rob, that you take from that?
Well, I think the challenging thing about this earnings season, and we've seen it in the economic data too, is it's been kind of in line as expected, nothing exciting, right? Nothing to tell us things are going horribly, but nothing for us to get tremendously excited about at this point either, which is kind of why we're seeing this range-bound market. And I think that's what we're hearing from NVIDIA. They delivered, right? They delivered on expectations. They slightly improved on forward views. And we've heard that from many companies so far. No one's been tremendously missing. Not no one, but right on average, right, we're coming in line with where we expected, and we're not getting a lot of forward guidance. And I think that's really the challenge for the market is with that lack of clarity, we're waiting for a driver or something to give us direction. And that's leading us back to the Fed, maybe tariffs, but we're not sure how much and how long, and then economic data.
So as you wait, right, you said you're looking to some of those areas of the market, like healthcare, for example. Healthcare that trade's gotten a little more crowded this year, right? It's actually the best performing S&P 500 group this year so far. So kind of what characteristics, I guess, are you looking for, either within healthcare or more broadly in the market, that you're looking to ride this period out with?
Yeah, we think it's companies that are sensitive to interest rates in a kind of constructive way. So as we get interest rates staying lower, right, the Fed's bias is eventually, maybe someday, to cut rates again in 2025. We think those are the sectors that start to do better. We've seen decent performance from real estate. We could see decent performance from utilities, particularly as they start to incorporate some of the past price increases into their earnings moving forward. And then healthcare really broadly rather than narrowly for us, because this is a sector that's been really challenged and things probably are not as bad as we've seen prices take the hit over the last couple of years, and things could get much better there.
What about technology and communication services, Rob? Would you stick with those sectors?
We think you have to be there in the long run, right? There's some real risk here at the top. For us, that's a long run hold. We think it's constructive over time. But certainly, as we're seeing today, right, there is some near-term challenges. And these are already very heavy weights in portfolios. So rebalancing remains an important thing for investors to think through how much, you're already kind of over-allocated in those spaces. It's worth looking to other elements of the economy that could see benefits as we press ahead, not just technology.
Rob, thanks so much. Good to see you.
Thank you. Very good to see you.